But let's get to some listener questions. Always fun answering some good listener questions. Number one coming from Patrick from Iowa. Hey guys, I want to quit my full-time job to invest in real estate full-time instead. I've saved up to be able to do some all-cash purchases, but I would prefer to finance properties with mortgages. However, I'm worried that I won't be able to qualify for financing if I don't have a full-time job. How do full-time real estate investors who are just starting out qualify for traditional mortgages if they don't have a job? In my case, could I use my saved capital, cash, and resources to somehow reassure these lenders that I have the resources required to service the mortgage?
Okay, probably not. So the last part, mortgages are going to qualify on income. So here's what I would say. First of all, if you've got cash and you have a job, my first question, we got to start getting these live because I love to know from Patrick. In Iowa, I was just talking about Iowa. Right? In the last segment, we talked about Iowa as being, not represented by the Case-Shiller Index. So I like Iowa as a market. And he said if he's got a full-time job and he's got a lot of cash that he could actually buy all cash, my first inclination would be to say, look, get the mortgages while you're employed. So take whatever cash you have. If you can put down 35 or 33% down payments or 40% down payments, buy as many properties as you're capable of that are going to be rented immediately or that are already rentals. That's a key point because the mortgage you can get from the local mortgage company that are out there everywhere, that are backed by Fannie Mae and Freddie Mac, that are the lowest rates out there, they will count most of the income from the property as qualifying income for the mortgage. If the income has been seasoned for at least 2 years, meaning you can't buy a vacant house and rent it out and then count the lease. It's got to have a 2-year lease history to count that income. So here's what I would do. Buy the properties, as many as you can, while you still have the employment. Because no place on the mortgage application does it say that you have to attest to the fact that you're going to stay in this job.
That's right.
It's not bank fraud to buy the property with your income and then leave your job. That's not bank fraud. There's nothing wrong with that, okay? So use the income from the job to qualify, maybe stay longer to save more money, and then get those properties in occupied condition as rentals if you can up front, because then going forward, if you can always buy properties that are occupied and performing, you can use the rental income as the qualifying income for that mortgage. So I love the question. I love the fact that he's so anxious to get out of the gig so he can do this full time. But my big question would be, how'd you save the money for these cash purchases? If it was the job, maybe you hang in there for another year or two if you can stand it in order to accumulate the basis for your portfolio. Get 6 houses, 8 houses, 10 houses under your belt. Now you have a base of income from those houses upon which to live and to qualify for the next mortgage.
Yeah, I think it's definitely a little misguided to say, hey, I just want to quit everything that I'm doing to go invest in real estate. Quite frankly, I think that's a bad idea, right? You go more into a cash flow negative position, and like you said, you won't be able to qualify for traditional financing. And if you don't have the history of doing deals, which in this case Patrick doesn't, then either you find somebody to partner with or you're going to be stuck paying hard money lender rates, and that's really expensive. And you won't necessarily be able to build a good relationship with your community bank as well. So keep your job for a little bit longer. Build up the cash, build up some reserves for the properties just in case, because if this is your first time investing, your first time owning rentals, then you need a little bit of that slush fund to dip into in worst case scenario. And you need to know that, hey, if I need to move into the property to make ends meet because my job is giving me that cash flow right now because I'm screwing up on this deal, you have a little bit of wiggle room. If you don't have a job, guess what happens? You take away your wiggle room, and your potential for failure increases.
Yeah, I mean, listen, the guy obviously wants to get into this full time. I think that's awesome. I think a segue makes a ton of sense.
Totally.
But you know what? You asked me before the break about one thing that I would look at in a market that makes it a good investment, and I stumbled because it isn't just one thing, but you can kind of boil it down to one thing. Patrick is from Iowa. Now, it wouldn't shock me if Patrick felt like he wanted to go invest in Vegas or in Phoenix or in Atlanta or in South Florida. But it also wouldn't surprise me if he was wise enough to realize that Iowa is perfect for this. Okay, Iowa, the home prices are really modest. The rents are higher in order to produce what is a really, really strong yield. And Iowa is bedrock. A lot of people get drawn into the places that are the most volatile, right? The places that have a lot of the heat on them. And they ignore the places that are considered to be, quote unquote, more boring, right? Like Iowa's boring. People goof on Iowa. Oh, Iowa's boring. Iowa is sexy as can be when it comes to long-term real estate investing because it's so stable. It's bedrock. And so I wanted to throw that out there because the thing that makes a real estate investment good, the one thing is the market desirable for people to live? And what goes into that is, why do they live there now? How did they end up there? If they were born there, why did they stay? If people have come in from someplace else, why did they come there? Are they planning on staying? When you can see really, really stable population trends, and Iowa's got them, right? I don't know what city he's from, but Davenport, the Quad Cities, all those places are such bedrock that's it. If you can find a place that has unshakable population, doesn't have to be rocket ship population growth. That's always cool, but what's also cool is being near where you invest. And so if you lived in Tampa where there's more of a rocket ship appreciation going on, great. But if you live in Iowa, maybe stay close to home because, man, it's just, if you do it right and you do it patiently and long term, it is so hard to lose in real estate investing in a place like that.
Completely agreed. Whenever I go back and visit my folks in Kalamazoo, Michigan, besides the funky name, Kalamazoo actually has a tremendous opportunity as well. Take a look at the universities that are there. Western Michigan, you got K College. You have a lot of good industry that's in the area, and nobody really talks about it. I mean, it's awesome, though. Like, there's so many folks that want to live in the city, great school districts. That's what you're looking for. And you're not going to find it if you go out to the East Coast or West Coast in some of these really expensive cities because, quite frankly, you might find the good school district. You might find everything else that you're looking for, but the price point for a long-term rental, it isn't worth it. So we got to go to break. Greg, I know that generally when you connect with investors, whenever you travel and you keynote and you speak around the country, there are generally a couple of good tips of advice that you have for these folks regarding either a framework on how to get started, just like a Patrick from Iowa. What's like your top one or two tips of advice as we're going into break here that you can offer some of our listeners that are thinking, well, geez, I'm kind of like Patrick, right? I'm saving up a little bit for a potential real estate rental investment down the road. What can I do differently? What can I do to get started?
I think the main thing is to go into this thing with a really long-term view. Don't be hasty. Don't necessarily just jump into the whole, I got to flip houses, I got to find me a junker foreclosure and flip it. Don't get seduced by that. This is not an asset class that inclines itself well to short-term thinking. It really inclines itself well to long-term thinking. So think of it in terms of, I'm going to have kids someday, or I have kids, and what can I do for them that might take 20 years before it actually matures and creates the outcome that I'm looking for. I'm X number of years old. I want to retire at Y number of years, and so I have Z number of years left. Do things in terms of long-term thinking, and it just slows things down a bit and helps you make smarter decisions.
And I really like what you keep saying. Give your properties an objective and a purpose. Right, the first one's going to be a slush fund for my new car. The second one's going to be for my kids, college education and tuition. Right. The third one's going to be for a little wedding fund. Do that, and it becomes more purposeful, and you're a lot more mindful with your investing. We got to go to break.